Lease means that you procure assets through lease. Now, if we talk about leasing, leasing is one of the category of finance. Leasing is a process by which firm can obtain the asset for which firm has to pay a contractual, periodic, tax deductible payment. So, if I want a particular instrument, I can get that instrument on rent. That rent will be called as your lease rent. Now, so leasing is a process by which we means firm can obtain fixed assets by making contractual, periodic and tax deductible payment. Why is tax deductible? It is allowed expenditure while calculating your tax. So we have two persons, lessee and lessor. Lessee is the receiver and lessor is the provider. So lessor is the owner who provide the asset, lessee is the user. Lessee is the user only, he can't be a owner. So relationship between lessor and lessee, or called as user and owner, is predefined so that terms and conditions are clear. The rent paid by a lessee to lessor would be called as lease rent. So if I talk about lease, so lease can be defined as a contract under which lessor means owner, the lessor owner of the asset gives the right to use to lessee, the user of the asset, for a defined period of time for the payment of some charges or consideration called as lease rental. So we are using the asset but we are not owner. So we are lessee but we have to pay lease rent. But we have two kinds of leases, either upfronted or back-ended. If in upfronted, we pay more rent in initial years and less rent in further years. But in back-ended, we pay more rent in the back years. Initially, we pay less rent. So we have upfronted and back-ended. See, similarly, we have primary and secondary. In primary lease, maximum rent is covered in 4 to 5 years. This 4 to 5 years covers almost full amount of cost of asset, which may be followed by less rent in other years. So we may have upfronted, back-ended, we may have primary combined with secondary. Now if we talk about terms of lease, in terms of lease we have a specific period of time for which lease is given, and the term condition and term or time is conditional. In case any event occurs, it can be terminated. In case of lease, what is the right of lessor, lessee is also defined. So lease is a arrangement between lessor and lessee to use the asset for some specific point of time. Now if you look at the benefit of leasing or demerits of leasing, there are so many merits and so many demerits. Number one, in case of benefit, lessee got the asset at less cost. So he is the user, he can get the asset without any finance. So he can use the asset and he is not responsible for any obsolescence. He has to pay only rent. So he got an asset as an easier point of time without affect any kind of risk, obsolescence, etc. But if you look at demerit, you have to make payment of lease rent. If you are not making payment of lease rent on time, your contract may be terminated. Second, you have no equity until you decide to purchase. Why? Because you can't become the owner. It means that you doesn't get any kind of equity stake in your equipment because you are only a user. Once term is over, you have to return back that equipment to the particular owner. Then, although you are not the owner, you are still responsible for maintenance. So you have to make payment, you have to maintain it, and you have to refund it. So these are not exactly demerit, these are disadvantages. So but still leasing is used by the companies for heavy equipment costing a huge amount of money. So next, so we have got to know basic understanding of lease. Now if we talk about type of lease, we have operating lease, we have financing lease, and we have sale and lease back. Let's go for operating lease. Operating lease is basically for short term. It can be cancelled by the lessor. So it is cancelable lease agreement. For example, we hire a car as tourist. We hire computers for usage, office equipment for usage. So that comes under your operating lease. Under operating lease, lessor is responsible for maintenance and insurance. Similarly, the risk of obsolescence remains with the lessor. Right. So under operating lease, number one, short term, cancelable, responsibility lies with the lessor either for maintenance, insurance, or any kind of risk of obsolescence. That all comes into your operating lease. Second part. Second lease is financial lease. Financial lease is exactly opposite of operating lease. It is long term. Number two, non-cancelable. Number three, the risk of maintenance, insurance lies with the lessee. Example, plant, machinery, ships, aircrafts. So that kind of lease is also called as full payout lease or lease capital. So, finance lease is a contract between lessor and lessee for hiring a specific asset which is selected from a manufacturer or supplier based upon lessee's choice. So, under this, all risks and rewards of ownership are transferred to lessee. Since it is long term, all risks are transferred to lessee. So, this lease is a non-cancelable lease. So, we have operating lease, we have financial lease. Third, sale and lease back. Sale and leaseback is a sub-part of financial lease. It is a situation where a company has purchased and is using the equipment in which then they sell to a leasing company who in turn lease back to them. So I purchase the asset, then I sell the asset to some other party, and then I take that asset on lease from the same party. For example, firm X buys the asset, now firm X sell the asset to Y. Now again, once they sold to Y, X again take on lease that asset from Y. That comes under sale and lease back. Sometime user may sell an asset owned by him to the lessor and lease it back from him. So called as sale and lease back. We sold out, then again we take it on lease. So called as sale and lease back arrangement. So we have operating lease, financial lease, sale and lease back. Similarly, we may have direct lease. Direct lease means that non-leverage lease in which lease meets out of the criteria given, meaning thereby under this lease there is no kind of equity stake or equity component. It is direct lease to lessor and lessee. On the other hand, if I talk about leverage lease, it is a lease in which lessor provides an equity portion of the equipment cost and lender provide the balance on non-recourse debt basis, meaning thereby see if I want to lease some equipment, even I don't have money to lease, so I buy the equipment by taking loan and then lease it to you. For example, firm X want to buy some equipment but they don't have money, so they take money on loan, get the equipment, then firm X give that equipment on lease to firm Y. So leverage lease. So under the leverage lease, lessor provides the equity portion of the equipment and lender pays the balance. So even the lessor buy the asset on a leveraged basis because he doesn't have money to buy it. So he pays 10 to 20, balance pays by funding body or lender, or he may 20 to 40, balance paid by the lender. He buy the asset and then give it on lease to the lessee. So we may have finance lease, operating lease, sale and lease back, direct lease and leverage lease. That all is the part of leasing. Similarly, lease can be wet lease, damp lease, dry lease. Under wet lease, one company provides instrument, maintenance, insurance to the other party with trained staff. All suppose suppose lessor provides some equipment, so lessor provides training, support, all services are provided by lessor for which he will charge. Now damp leave. Under damp lease, all things are provided, not only trained staff. They provide all service but trained staff it will not be provided. Now dry lease. Under dry lease, suppose for any rig company or any oil company, so entity provides all service, training, etc., but no insurance, no staff, no maintenance. So under wet lease, all things are there: maintenance, training, insurance, staff, etc. Under damp, staff is not there. And dry lease, what happen? They provide only equipment, no maintenance, no staff, no training, etc. So we may have wet lease, damp lease, and then we have dry lease. Now, so leasing has benefits which we have already done. It is convenient. There is shift of risk of obsolescence. You have maintained maintenance by the either lessee or lessor. Now let's talk for lease evaluation. If I talk for lease evaluation, we may have lessee point or we may have lessor point. Let's look at lessee point. Lessee use various models to evaluate it. Now lessee will calculate NPV or IRR. Now what he calculate? What is the present value of cash inflows which and present value of cash outflows. Now by using the same equipment, how much cash inflow or sales he is generating. Second, how much rent he is paying. So he will calculate present value of cash inflow and present value of cash outflow, whereby he find out NPV is coming positive or negative. If NPV is coming positive, he will go for lease, otherwise not. Similarly, IRR. He may also calculate rate of return of, if we buy the equipment, what is the rate of return? If it gets on lease, what is the rate of return? So while computing IRR is that rate of return or called as internal rate of return, whereby your present value of inflow is exactly equal to present value of cash outflow. So he evaluates all the decisions for buy or lease. If he buy, what is the IRR? If he takes on lease, what is the IRR? Internal rate of return. So from lessee's perspective, he may go for NPV assessment, he may go for IRR assessment. Now let's go for lessor's perspective. If we talk about lessor's perspective, see, for lessor's perspective, obviously he also need to calculate cash inflow and cash outflow. Now for lessors, what is the cash inflow? For lessor, cash inflow is initial deposit or security deposit, lease rental, management fees. So he got deposit initially, maintenance fees, lease rental, and most important, he got tax benefit. Since he is the owner, he has the right to claim depreciation. If he claim depreciation, his income will be less and he will got tax benefit. Moreover, he is also entitled for salvage value. Now question come, what is the cash outflow? Cash outflow number one, he has to buy, so purchase cost. Then he has administrative cost. He has to give sales tax. He has to arrange money to buy the asset. So he have certain cash inflow and certain cash outflow. No doubt he has also a concept called as cost of capital. Why? Because while financing the asset, he has to arrange money, so he has some cost to undertake. Now what lessor does, lessor calculates the present value of cash inflows and cash outflows. So what he does, he calculate what benefit he is achieving. So what is getting benefit? Beyond lease rental, he is getting benefit of depreciation charge, he is getting the benefit of salvage value. So what he does, he calculate the present value of depreciation benefit, he calculate the present value of salvage value benefit. So he does depreciation divide by 1 plus rate raised to power time. Similarly, salvage value divide by 1 plus rate raised to power time. That's way he calculate present value of cash inflow. So he got three cash inflows. Number one, lease rent. Number two, salvage. Number three, tax benefit because of depreciation. So he calculate present value of all cash inflows. Right? So lease rental, depreciation charge benefit or called as tax benefit. Third is your salvage value. Then he calculate post-tax lease rental. So what does net recovery of lease rental? What he is achieving? Net recovery of lease rental divided by PVIFA, present value interest factor annuity. Why we divide by PVIFA? Because lease rent almost remains same every year, whereby he got post-tax lease rental benefit or value. Once he got post-tax lease rental, then he divide post-tax lease rental by 1 minus T for tax benefit attainment. So he got his lease rental value. So he calculate post-tax lease rental and he also calculate lease rental. So post-tax means net recovery of lease rental divided by PVIFA. Then lease rental is post-tax lease rental divided by 1 minus tax rate, whereby lesser does the evaluation. So lessee use IRR and PV, lesser use number 1 present value of cash inflow, be it lease rental, tax benefit or salvage value. Then he also calculate present value of outflow on account of purchase, administration charges, maintenance charges or financing charges. Then he calculate post-tax lease rental and lease rental. So under this unit we get to know the basic concept of leasing, we get to know how it can work as a source of finance. We have certain merits, certain demerits, then types of lease, operating, financial, wet, dry, damp, leverage, direct, sale and lease back. Then we have got lease evaluation from lessee's perspective and lessor's perspective.